Let's break down NIO's stock action. Will we break this support level and will the stock start falling further, or are we about to start rising? The answer can be found with the volatility smile, as well as the trading volume of options, which is concentrated around $4 very important levels. We'll also assess the market forecast, and I'll show you 3D volatility. I'll also share a couple of interesting strategies that I've developed using options. Let's start from the beginning. The stock has been falling for some time now and has dropped to the $3.50 level, which we haven't been able to break through yet. However, this is not the lowest point, as the lowest values were in 2019. So what's happening here and what's the potential for movement? Let's begin with volatility. The volatility smile is pointing both upwards and downwards. If we look at the longer expiration dates, investors and traders are leaning more towards a decline, meaning more towards put options. The volatility on put options is higher, so put options are more expensive. This is a normal situation because investors and traders buy put options in hopes of hedging their positions, making put options typically more expensive than call options. Historical and implied volatility, what's happening here? The gray line represents historical volatility, while the white line represents implied volatility. As we can see, at the moment, implied volatility is much higher than its historical values. This is undoubtedly due to the stock's decline and the potential for further downward movement. This is why volatility is currently above its historical values. I remind everyone that you can trade not only the underlying asset, but also volatility. In fact, trading volatility is much easier because volatility always returns to its historical values. Let me show you one of the strategies that artificial intelligence can help us develop. We're talking about a 15% drop in volatility. This is a fairly normal decline, corresponding to a return to historical volatility. So we're betting on a decrease in volatility. Let's see what the AI suggests. We have different strategies with varying probabilities of profit. Let's consider one of them. The suggestion is to buy one call option with a strike price of $3 for November, sell two call options with a strike price of $4 for November, and buy one call option with a strike price of $5 for November. This is a type of butterfly strategy, and I must say it's a very interesting one, but it requires active management. You can really profit from a decrease in volatility with this strategy, but again, it's important to buy and sell options at the right moment. I often turn to AI for interesting ideas because it can highlight some intriguing opportunities. We've gone through the details, but I don't recommend blindly opening this strategy. You should thoroughly understand options and derivatives. I'm just showing you how to play the volatility. Now, let's focus on the most important aspect of trading volume in options. This reveals the key points. The call options have a significant volume concentrated at the $4, $5, and $3 levels. These act as resistance levels, with $4 being a very strong resistance level for call options at the moment. However, if we break through this resistance, we could see a sharp rise. For example, in April, there was resistance around $4. Once we broke through it, the stock rose by about 50%. And why not? That's a substantial increase. Let's now look at the put options. Here, the situation changes a bit. There is massive support around the $4 level. Yes, we broke through $4, but the put options are still concentrated above this level. Likely when someone buys options, someone else is selling them. If you sell a put option, you are effectively stating that the price will probably not close above $4. This is a crucial point to note. The consolidation at this level is likely not happening by chance. There could be an accumulation of volumes. The volumes also provide insights into the options market. As we can see, there is a significant amount of volume at the $4 level, almost 30,000 contracts. This is something to watch closely. Let me briefly explain how options and market makers work, as this is an important aspect to understand. When someone buys options, whether puts or calls, there is a seller on the other side. This could be a private investor or a fund, but usually it's a market maker. When you buy a put option, for example, the market maker has to sell you that put option, which exposes them to unlimited risk. If the stock goes bankrupt, they could suffer substantial losses. Therefore, they must hedge the sold put option. The market maker hedges by selling shares, effectively taking a short position in the stock. This is known as delta neutral hedging. That's why I pay attention to these options. Yes, the volume is significant, but we must remember that it includes both bought and sold contracts. You see, right? So there are 23,000 bought and sold contracts, meaning we can effectively double that figure. We can't forget this. And of course, those who sold the options probably know something and aren't doing it without reason. It's possible that there's some accumulation of volume happening here, so we should keep an eye on it. Now, let's take a look at the market forecast. What's happening here? Let's start with September. As we can see, the market is pricing in a 40% chance that the stock will be worth between $3 and $4. This isn't surprising because we have an earnings report coming up at the end of September, and the market is still uncertain about what the outcome will be. However, If we look beyond the report, things become more interesting. We see that the highest probability is that the stock will be in the $3.50 to $4.50 range. This is for September. If we look at longer expiration dates like December, the picture remains the same. The stock is expected to be in the $3 to $4 range. Now let me show you 3D volatility. What's happening here? Professionals often use this to form their positions and strategies. It contains all the information about volatility and options. The graph currently looks like this. Let me reiterate my philosophy. I don't know where the stock will go. My primary objective is to manage positions wisely using derivatives, to build a strategy with options so that no matter which direction the stock moves, we profit. Let me show you an example. As we can see, if the stock rises to $7, we comfortably earn $10,000. If the stock falls to $1, we still make $4,500. Yes, we have a small loss if the stock stays at $3.50, but overall the strategy is quite profitable. This is what I mean by smart position management, designing a strategy and positioning yourself so that you earn regardless of where the stock goes. That's the secret to success. Again, I don't focus on charts. As you can see, I usually spend little time analyzing the charts themselves. I don't draw Elliott waves or look at moving averages. I'm not saying those methods don't work. They might work in certain scenarios, and I agree to some extent. That might work, but I approach it a bit differently. I focus on mathematics, mathematical analysis, and ratios, as well as on managing strategies and positions. Think about it. If you learn how to manage your positions effectively, it won't matter where the stock goes. You just need to shift your focus a little. I understand that many bloggers and traders spend a lot of time showing charts and predicting whether a stock will go up or down. But remember, I firmly believe that no one knows where a stock will go. No one, not even the market. I always show you the market's forecast, and the market might predict 20% in one direction, 15% in another, 17% elsewhere. You see, even the market itself doesn't know where the stock will go. It just makes educated guesses. Yes, these are the best guesses because they are made by the market itself. But as we can see, the accuracy isn't very high, minus 30% up, 30% down. Any blogger or investor can tell you that the price will either go up or down. So if no one knows where the stock is going, how do you make money? Here's my real advice: make money through positioning and smart strategy. It's tough to do this without options. Naturally, I'm talking about the complex market, the derivatives market, the options market. This is real. When I first learned about options, it completely changed my perspective. It's very difficult to play the market effectively with just the underlying asset. For example, you can't really profit from consolidation without options, but with options, say, by selling an iron condor, you can easily take advantage of any consolidation. That's what's so great about it. Now, let me show you the strategy itself. Here's how it looks. The strategy involves different expiration dates, different strikes, and both selling and buying options. It's a very complex strategy, and I don't recommend opening it. I have many other strategies, and this one requires careful management, selling options at the right moment, buying them at the right moment. This is just a demonstration of what can be done. Now, let's get back to the NIO stock and talk about the charts. Again, what might happen here? The key level where we've stopped is $3.70. We haven't been able to break through it yet. If we see a breakout to the upside, we could potentially see a significant rally, maybe 50 to 60%, which is entirely possible. I also think we might trade within a plus-minus 10% range until the earnings report, and after that, we'll see what happens next. I'll definitely share the report, along with our prospects and plans. But the most important thing I always emphasize is that if you believe in this company, then when the electric vehicle boom returns, this stock could see significant growth. It could potentially even surpass its historical highs over 2,000%. That's a massive increase. As we've seen with Tesla, the EV boom has passed, and it's been nearly 4 years since the stock has been able to recover to its previous highs. That tells us something. However, history often repeats itself. It might take a couple more years, but when we see the advent of electric taxis or cars truly powered by AI, it could change the game. The key thing is not to go all in. If NIO makes up 10% of your portfolio, that's the maximum you should hold. I wouldn't recommend anyone to invest more than 10% because it's risky. Anything can happen. The company could go bankrupt, and losing 5 to 10% is not as painful. On the other hand, if we see a strong rally, you'll still profit significantly even with just 10% of your portfolio invested. I hope that makes sense to you. I also recommend checking out the analysis I did on Tesla stock, as there's a lot of interesting information there as well. If you have any questions, feel free to reach out. Best of luck to everyone.